Hi, students. This week, we're going to talk about crypto hedging. My name is Yusuf Bonaparte, Assistant Professor in Finance, CU Denver, Director for External, and that's my name. How people view crypto. Some people view crypto as digital coin. Is it? Some people say it's an asset to hedge against inflation. Is it? Hedging against interest rate, high rates. Is it? Or correlated with money supply? When more money supply, you can make more money by buying crypto. Is it? We don't know. So the goal of this week exercise or this video is to examine maybe some coins are good for gold, some coins good for hedging against inflation. We didn't know. So we're going to analyze one coin. If he does what exactly to move or hedge against one of these asset class, and then get some inference. How to do that? We're going to use the model by Santa Clara. He did it about stock market equity, not crypto, but we're going to use the same model. RTG is a crypto return, equal alpha as a constant, PG. Alpha J is constant for coin J, and beta J is the movement between market return and crypto return. And MUT is the unobservable. And beta J is called the beta, crypto beta for equity, how much the risk equity market add to crypto. Now, since this is the first time I'm going to talk about it, the MUT, we never touched it before. We just said it's unobservable. We try to touch it today by showing what is that. We looked at the unobservable variance of the MUT divided by the variance of RTG. If it's above 25%, that means the unobservable is high. Now, before we looked at the R square, which reflects the fitness of the model. And obviously, if the R square is small, then this quantity will be high. If the R square is high, that means the unobservable are very little, and then this quantity will be very low. So today we at least add to this our analysis this quantity. So the empirical model that we're going to employ this week is a crypto return equal constant plus beta J multiplied by RM, so that will move the equity, plus theta J multiplied by hedging asset. What asset? Gold or inflation, interest rate, or money supply, plus a MUT. So if theta J is positive, that means we're going to say that there is a positive correlation or co-movement. When the gold price going up, the coin going up, that means it's a digital gold. This crypto is a digital gold. If gold going up and the crypto price going down, then that would be different. So it depends how do you do it. If theta is below zero, it means hedging. If it's above zero, we call it co-movement. Hedging or a neutral. So this is the things that we will focus on it. So how we're going to do it, we're going to run 4 models. Each models will give us a theta 1, theta 2, theta 3, theta 4. And then based on the results, we can get inference about each one of these assets. And then this slide will give you the conclusion. We're going to estimate the model. For the gold, we're going to use GLD. It's a ticker in Yahoo Finance. For inflation, we're going to use the CPI index, and that's from Fed. For interest rate bond, we're going to use the TNX from Yahoo Finance, and money supply Fed. So how are we going to do it? We're going again to crypto market cap, and we're going to select a coin. I'm going to go again with Cardano. I'm going to go to Yahoo Finance. I'm going to get Cardano. Historical price data. And we're going to go monthly. And we're going to go max, apply, download, Boom. So the return for Cardano is the following, equals to November 1st, October 1st, November 1st, October 1st. So the return in October, adjusted close minus end of the month, minus adjusted close beginning of the month, divided by adjusted close beginning of the month. That's a return. Boom. Now, next, we're going to get the gold return. So we're going to go to Yahoo Finance again. Gold is GLD. Historical data. We go monthly. We go max. Apply. Download. Boom. Gold. So the adjusted close for gold is the same. We're going to say return for gold equal adjusted close like January 1st here minus beginning of the month divided by beginning of the month. Enter. Double click. Remember, in our sample, we start from October 1st, 2017. So I don't need all of that. I need to go all the way to 2017. October 1st, 2017. And that, right click, copy. We're going to put it here and write gold. And here, right click with the values. Okay, I have to do it again. Copy. And right click values. Boom, we got the gold. Next, in our list, and you will have this Excel file, so you can use it. All what you need is to get that CPI. The next CPI, we're gonna get it. So this Excel file, you will have it when you do your analysis. This one, you will have it when you do your analysis, inflation. So that's the next one. We're gonna go to Fred. CPI. So that's a CPI, and then I want monthly. Okay. And then max download. Excel. Enable. So inflation for January will be equal to end of the month CPI minus beginning of the month CPI divided by beginning of the month CPI. Double click. We didn't care about all of this. We need to go to October 2017. That's October. And right click, copy. We go here. We got the inflation, right click and values, not copy paste. Next, what is next for us? Money supply. Oh, interest rate and then money supply. Interest rate, we're gonna get it from Yahoo Finance, hat TNX. Or you can get it from Fred also, but that's fine. Either way is fine. Ten years treasury, historical data, monthly. Next, apply, download, boom. So rate change. So January 85, February 1st, 85. So that means in January, the change is this minus this, end of the month, beginning of the month, divided by beginning of the month, enter. Double click. Again, we need to go to October 2017. Copy. We're gonna go here again. Right click, values, and this is interest rate change. Change interest rate change in interest rate. Change. That's a Cardano. We forget the S&P. S&P return. And all of this data, you will have it in your folder in your canvas. S&P is a spider, that's PY. That's an ETF for the S&P that reflects the S&P index, historical data, monthly. Max, apply, download. So S&P return equal to, so that January, February 1st, March 1st, the same. The adjusted close minus the adjusted close in the beginning of the month divided by the beginning of the month. Double click. We didn't need all of that. We need to go straight to 2017. That will give us October 2017. And right click. And yes. Give us S&P values. Boom. What left is money supply. I call it money, change in money. Money. And the money supply from Fred. All what you have to do actually go M2 here, right? M2. M2. That's a money supply. M2 is the money supply. Monthly, good. Next, download. So M2 money. So billions of dollars. But it doesn't matter for us. We're going to do the change. This in the end of the month money supply, in the beginning of the month money supply divided by beginning of the month money supply. Ooh, didn't care about all of the early data. We're going to go straight to 2017. And October 2017. And that will be a copy. Save value. Before we go further with the analysis, I'm going to delete all of those observations unneeded. Now the gold has something interesting. I want to do the gold again. Make sure we got it right. Gold is GLD. Done. December, January. Okay, so it's equal to adjusted close minus in the month minus adjusted close early in the month divided by adjusted close, double click. And then I want to go all the way to 2017. Right click, copy. Past values. Oh, okay, so it has only 3. I'm going to delete them. Delete. Good. Now we have everything right. Good. Now we'll go back to our model. We want to estimate these models. 1, 2, 3, 4. So, and then report result here. We're going to start with gold. So first, this is our return. So I'm going to color that return in yellow, and the rest our x's. I'm going to color them in gray. So what you need to do data and data analysis. If you didn't have data analysis here, you need to add it first. The way to add it, if you didn't have it, is you go so if you click on data and you didn't see anything here, data analysis, go to files, options, add-ins, go and check out these boxes. Okay, and then you're gonna have here data analysis, click on it. I don't know how it works for Apple computers, but so you just go to Google and search how you do it in Apple computer. So Excel, regression, your Y is, this is your Y. Notice I'm gonna use the first row here. So I'm gonna click the labels. And my X, we're gonna start with S&P and gold. And okay. So based on this analysis, first of all, R square reflects the fitness of the model to the data. The comma the model explain how much the model explains the data between X and Y, X and Y. It ranges between 0, which is perfectly unfit, and 1 means perfectly fit. Perfectly fits. So never 0, never 1, but it's in between 0 and 1. If it's 1, that means perfectly fit. It's number 1. So the interception here is positive. That means Cardano to move positive with the gold and S&P. Now here I want to stop a little bit here. The blue, this is your beta. Beta is the blue, reflect the riskiness of Cardano relative to S&P. 2.8 means that this coin is 280%, 84% riskier than the S&P, because the S&P risk is 1 and this is 2.84. That means 284% riskier than S&P. Next, theta, this is our theta. I'm going to put it in gold, in green. Theta is negative 0.43. That means that this coin, in this case Cardano, is negatively correlated with gold. Correlated with gold means it is not a hedging. It is a hedging. It is a hedging and not co-movement. So not positive correlation, negative correlation. That means it's a hedging. So if you want to hedge against digital gold, you can buy Cardano. So that's gold. Now, I'm not going to do the other, and the interception here, I forgot to mention it. I mentioned a little bit. That's alpha J in our analysis here. Alpha J, so alpha Cardano in this case. So in this case, alpha is positive equals 1.1769, means higher return than the S&P and gold markets. That's what it means. And I'm going to put it here in a different color, light orange. Bright orange. Now the R square is small, so that means the this quantity that I mentioned it is very high. The variance of the error term divided by the variance of RT. I'm gonna do it to show you how much is quantities, but you didn't have to do it, but it's interesting to do it. So mu, in this case, mu for gold, in the gold case, equal to Cardano return minus this alpha minus this beta multiplied by S&P plus this multiplied by gold so this minus should be minus here, sorry. B17 minus should be plus in this case. Gold let me do it differently. Equal this plus this multiplied by S&P plus gold multiplied by this. So the error term equal to the return here minus all of those. That's the error term. Now, because I did series here, so we need to put the numbers. double click. That's the error term, mu, and calculate the standard deviation or the variance, whatever you want to do, either one's fine. That's a variance I'm going to use. That's a variance for the error term. Again. Can use the standard deviation instead. And then if you calculate this ratio, which is this standard deviation divided by this standard deviation, it's very high, 85%. And that because the R square is 2.8. So the lower the R square, the higher this quantity. But we're not going to focus more on it. We're going to go back to our business. So we did the gold. Now we're going to go to inflation. So we're going to run the same model, data analysis, regression, the same Y. Now the X is different. The X will be S&P and the inflation. The S&P and inflation. Comma inflation. Okay. Oh, we cannot stack it together. Cancel. We need to hide the gold. Now we can have S&P and inflation. Regression. S&P and inflation. Okay. And that will be inflation. It includes gold here. And we don't want gold. So the way to do it is unhide, insert, copy. Now we can do it. The same Y, the X will be S&P inflation. Okay, so that will be inflation. So look at this Cardano with inflation. It is negative. That means it hedge Cardano. So this theta J. Again, the R square is low. The beta 2.73, that means 200.73. The access return is high. Theta, what we care here, and that will be theta what? Inflation. Theta 2. So theta is negative, minus 11.66 means hedge against inflation. Now it's important to mention that the t-stat or the p-value is very low at t-stat here, but that's fine for the results still showing that it's negatively correlated with the, how did I do this? Green. So the theta here is negative. That means hedge against inflation. So hedge against inflation. And before we have hedge against gold. Now we're going to see the interest rate. And we can have data, full data. So we're going to put a change in interest rate now instead of inflation. And we're going to do the same model, data regression. Okay, the same Y, the X is different, S&P. And okay, and that will be interest rate. And again, the R square is low, but our focus on this, theta, and theta here showing 0.465 means movement with interest rate. Like when the interest rate going up, Cardano going up. So movement with interest rate. Movement with interest rate. So be careful here. This is important because when the rate going up, Cardano going up, that means if you think the Federal Reserve is going to continue to raise the rate, then you should buy Cardano. Finally, one more left, which is money supply. Copy. Again, we're going to do the same regression, data analysis, regression. My X is S&P and money supply. And okay. And boom, money supply. It's positive. Theta equal to this. And that means the more money supply, the greater the return of Cardano. That means movement, not a hedge. Okay, so that's, here you have it. That's the end. 1, 2, 3, 4, full data. Okay, that's the end of the analysis. Positively correlated with money supply or movement with money supply. And that means these are the results. If you want to hedge against gold, it can be a great hedge for gold. It can be a great hedge Cardano for inflation. If you think the interest rate is going to go up, then buy Cardano. Move with this and move with money supply and moves with interest rate. And it's a good hedge. That's it. Here you have it. So what's your homework? Your homework, and by the way, we show here when the interest rate, when the R square is low, this quantity becomes to be big. So today, at least, we also explain what is that residual and how they impact our analysis. We'll be talking more. So what we did today is we take a coin, different coin give you, different crypto give you different results. But we took this coin, Cardano, and then we examine, is it digital gold? If it's digital gold, that means it will be co-movement. When the gold price going up, this will go up. Is it hedging against inflation? Is it hedging against interest rate, or correlated with money supply, or hedging against money supply? And then we did the model. We also looked at the observable to make sure that it co-moves with the R square. And then we talked about a model of either co-movement or hedging or a neutral. We consider 4 asset classes, and we looked at the theta J, and we got some inference. Your homework is simple. Choose a different coin than Cardano, any coin, and do the same analysis. Now, you will have this Excel. So all what you have to do is to change in numbers here, the return of the coin, and then do the same regression. And that's all. Thank you so much. And I hope you enjoyed this video and help you with understand the coin key characteristic, whether hedging versus co-movement, and how to use crypto as a hedging asset.